this, and he also said that there will be an article of the company in Talouselämä, which is a Finnish weekly business magazine, kind of the leading one. Obviously, it's in Finnish, but if he will be able, that will be published. Okay, I don't know whether this week's Friday or next week's Friday. We'll see, but it's kind of I asked him that if he could make that kind of a copy of that as well. So he promised to send that once he received that. So kind of that is pretty timely. It's a cool company. It's kind of growth company. They also raised equity last calendar year, last spring was it? So a couple of tens of millions. Not that they need the money, but they wanted to have foreign shareholders on their field. And I asked him that not only present himself and his career, but also explain what happened in this equity raising, plus explain also how the crypto market currently is doing. Okay, so that will be next week's Thursday. Last week's Thursday, last time we met, there was a question on chat, excellent question about Friedman's K% rule, which I had not read earlier, but obviously thanks to the wonderful internet, one can easily find it explained. On these specific course on financial market institutions, while the Friedman's K% rule is kind of like a theoretical proposal for the central bank's policy, and there's a lot of some criticism also has been provided. It has not been accepted by any central bank so far. So that as a topic kind of goes beyond what we are supposed to deal with on this course. So I would not go into details of that, but obviously, but I aim to explain kind of how the central bank, what tools have been adopted, how the central bank policies in the US and in Europe has developed over the recent years, and that's enough for us to know. Definitely an interesting area. What is the optimal central bank kind of liquidity providing policy? Should it be kind of more mechanical, or as it is currently, you could easily kind of say that it's a bit, central bankers are not that independent from political kind of decision making, which this Friedman's policy had. I guess the main aim was to make it as neutral politically as possible. Which one is optimal, and at the end of the day, the jury is out there. So kind of what we know is that central banks have adopted new tools and also changed their policy over the years, and how central bank policies will be in, say, 5 years time, 10 years time remains to be seen. But that is not the kind of say the contents of our course. So kind of I encourage anybody interested in kind of different central banks kind of policies and theories behind those, take a closer look at. We can easily do that, but kind of we are happy kind of it's enough for this course to go through kind of what they really have been doing, and to understand why they are in the position as they are currently especially in Europe and also in the US, and how critical a role they play in current financial markets. Why when the Fed makes some announcement, and when the chairman Powell is interviewed, why he is so important, why is everybody so interested in what he's saying about any indications of how their policy might be changing in the future, but not beyond the topics of the contents of this specific course. Okay, financial regulation. We have been touching upon this topic a few times and obviously, the whole regulatory environment, the framework, as it is currently, is highly impacted by the global financial crisis, great financial crisis, 2007, 2008. So a lot has happened after that. We went through is pretty quickly, kind of jumped this on the second set of slides at the very end, big questions in bank regulation. Today, I aim to provide first explain you why these are important and what are the different kind of alternatives that we might end up as the questions that were set then were quite many of them and pretty extensive. These are not black and white questions per se, not many of these. So, but what we know is that these questions have become more visible and more concrete at the global financial crisis and after the global financial crisis. So essentially today our aim is to understand why these questions are relevant and what might the potential the answers be. Today, at the end of the lecture, let's come back to the questions: why do we need regulation? Who regulates? What do they regulate? We mostly talk about banking currently, and what are the costs of regulation? So first, why do we need regulation? You might think that as this was the question, remember kind of in Reagan's time, in the US, where the common understanding then that Larry Summers was promoting as one of the leading advisors for the president, and also what Alan Greenspan was kind of promoting, the idea is that as less regulation, the less regulation is better for the freely functioning market kind of will end up as the best possible outcome. As we learned that there were risks, and the risks realized 2007, 2008. So we seem to need some regulation to make this, there's a capitalistic system work, which is kind of pretty, it's kind of like a bit controversial, but that is how it is, especially in the banking world. Banking world is different from, say, industrial world in this with this respect. And why that is different is that there's this bank contagion risk. I use the word domino effect. If one bank fails, as all banks are interconnected, not only on a national level, but on an international level, through different various contracts, kind of not the least derivatives markets. So failure of one bank may easily kind of force another bank to fail. And failing banks, 1, 2, 3, 4, kind of, if the whole banking system kind of collapses, so that there will be social costs also involved. It's not only about the money, as we will see. The whole system relies heavily upon confidence. You remember this lender of last resort, the central banks. One major role in functioning economies is that we know we can trust on our local commercial banks, as we know that if something bad happens for them, so they will be, if they kind of, so they will be able to borrow money from the central bank, kind of, no matter what happens. So there will be somebody lending them money, even in the time of bank runs. So what the bank run is in practice, it is that the public. So group of people begin to suspect that the bank may become insolvent. So these investors, depositors, try to withdraw deposits immediately. As the bank doesn't have this money, as the bank has lent that in form of illiquid mortgage loans, corporate loans, so bank does not have that cash to provide for these depositors. So as the loans are illiquid, bank needs to sell them at whatever price. So there are fire sales, bank faces losses, and bank becomes insolvent. And this, as I've highlighted here, that even if they are sound, so does not mean that the bank needs to, that it's not necessarily that only bad banks face a risk of a bank run. It's just kind of as I once suggested or mentioned the experience from Finland in 2000, and that was before the global financial crisis, when Icelandic Kaupthing lost its license to continue in Finland. So people got nervous. The customers of Nordea, customers of OP, customers of Danske, or then it was Sampo Bank, got nervous because they thought, okay, it seems that the bank can kind of be forced to close its doors. So people got nervous, even though there was no whatsoever reason to become nervous. But okay, people get nervous, so they get nervous, and even sound banks, even solid banks can face this risk. So it is a concrete risk that even good banks may have. If it happens that the bank faces a bank run risk, so it's not only that the bank's depositors lose. As the banks lend money to corporates, to households in terms of mortgage loans. So if a bank goes bankrupt, so not only the depositors lose their money, but also banks cannot provide financing for their clients. So it will lead to bankruptcies also in, say, real industry. So, say, manufacturing companies will go bankrupt as they cannot finance the operations. They rely on, some of them rely on the short-term financing, on the payment system, depends on the well-functioning the banking system. So these social costs, which are called externalities. So bank taking in deposits, making loans to customers, industrial or whatever corporates and households, facing a bank run and collapsing, does not, the damages do not limit to the clients of this one bank and the depositors, but they are faced also in the whole economy. This is, put it the other way around, as we are currently kind of running a well-functioning system. So on the positive side, so we have a well-functioning, efficient system, payment system, as we benefit from the banking system kind of being kind of running smoothly. So this is a benefit that this is a something that we all benefit, not that we pay any attention to that. So that is called external benefit. This the other way around, if it kind of disappears overnight. So even though I didn't have any deposit on a bank that went bankrupt, or I didn't borrow any money from that, or I wasn't any client to that bank, so I also may be hurt. And that's kind of that is in society, in society, something that the risk, these externalities are something that say the decision makers do not want to face. This one timeline shows, and this is, I took it for two reasons, actually three reasons. This is kind of graphically pretty nice. The second thing is that it shows that it's not only global financial crisis hit Lehman Brothers, it also happened in UK, and the third, it happened some incidents took place before the Lehman Brothers. So this is something called Northern Rock. Every now and then, as a company mentioned in financial media. So what happened there, if you look at kind of September 13, 2007. So this is 1 year before the Lehman Brothers went bankrupt. Lehman Brothers filed for Chapter 11 in September 15, 2008. So exactly a year before, there was in the news, BBC revealed that Northern Rock had asked for help from the Bank of England. As that became a public knowledge, the next day, this is the picture kind of in front of the Northern Rock's kind of office or branch. Queues started forming outside Northern Rock branches. Then the government needed to come and say publicly that they guarantee all the deposits. So that happened a year before the Lehman Brothers. Then Lehman Brothers went bankrupt. Some other kind of British banks or financial institutions, insurance companies, banks kind of faced problems. In 2011, Virgin agreed to buy Good Bank of Northern Rock. So it was nationalized, the company was nationalized, and then segmented into two different kind of portions. So the Good Bank, a viable bank, and that was sold for the Virgin, and the rest, kind of the bad bank, that was kept in the government kind of ownership. Obviously, shareholders lost their holdings. Depositors at the end of the day did not lose anything, but this was a big thing in UK. So it happens very quickly. You might remember I mentioned this somewhat shortly, but last Thursday, as I was, we were covering the central bank's tools and actions. So one of the first actions the European Central Bank, something that Fed, American Central Bank, has not utilized, but European Central Bank has utilized now for 3 different rounds of targeted long-term refinancing operations. What those are? They are targeted, so banks are told that you can borrow money from the central bank at a really attractive terms, which was kind of the deposit rate, and the deposit rate currently is minus 0.5%. So you receive money, we pay you money if you borrow from us, but this targeted means that if you agree, if you commit to forward, to channel that money in term as loans for real, say, investments for corporates, not you are not supposed to lend this money for speculative purposes, but for something that kind of creates something concrete. That is the idea behind those, and they seem to function relatively well. Mostly utilized by Italian banks, as there was one statistic. Before these TLTRO, targeted long-term refinancing operations, there was LTRO without the T. So there was no this targeted at all. What that was, as I very shortly mentioned, has to do with this kind of Northern Rock, in the sense that at that time, the first round was that all banks were told that you can borrow money from us cheaply. That's it. And you can do whatever you like. And many, especially Southern European banks, it turns out we learned afterwards that what they did with that money, they borrowed cheaply from the central bank, and they bought the local government bonds, which the yields were 10%, 12% or so. So they made profit out of the opportunity to borrow money cheaply from the central bank and put that money on the government local government bonds, which essentially kind of you could say, is it right or is it wrong? Okay, that was the first one. Why I mentioned it here was that, as that's something that I shortly mentioned on Thursday, is that as all banks were told that they have this option, banks were really reluctant to publish that because not all banks utilize this. Say what happened in Nordic countries was in Finland, Nordea as the first bank, they told in public that we are not utilizing this opportunity, so we are not borrowing. So why did they come to public say that we don't borrow cheaply from the central bank? The reason was that they wanted to show everybody that we are solid, we have we are a good financial position. We do not need this cheap borrowing from the central bank. Then came other banks, because in a way there were rumors that one bank has been utilizing this opportunity, and other banks followed Nordea, saying, "Okay, we are not joining this either." Okay, Danske Bank then they needed to disclose that they are using this opportunity. It was seen as a sign of weakness, and that's could be one reason why it has not been used ever since. It was just one round. Later on, the financing, the tool has been TLTRO, targeted long-term refinancing operations. Okay, talking about the banks, there's a consumer protection side here as well. In general, markets work on the basis of caveat emptor. So that is in practice that buyer has obligation to check that what she buys is suitable for the purpose. So it is customers' responsibility. And in this case, to find out how solid is a bank, say, on which I deposit my money. You could say that without any regulation, so I would be very careful in carefully making financial statement analysis on which bank I'm willing to deposit my savings. Because I would not be willing to deposit that on a weak bank. I would choose the strongest bank in the market. But that is just the bank deposit. We know from the previous, as the question was that why banks' balance sheets are so difficult, so hard to evaluate. That is in the heart of the risk management of a bank. Bank makes, with the money that they will borrow from market, they issue bonds that they take in deposits. Banks make these illiquid loans. But that is not public information to whom bank has lent money. That is not public information. As a customer, I can't find out if the bank has made hugely illiquid risk investments, illiquid loans. Not to mention that banks can offer us other products as well, which can be very complex. Bank deposit is the most simple one I think of, but banks do sell us different products, mutual funds. We will talk next Thursday, the next lecture. Pretty straightforward as such. Could be some plain vanilla usage funds, as we discussed. Could be some alternative funds, could be hedge funds, could be whatever. Could be some financial contracts are really complex. We as customers, we need to be protected from kind of the banks selling us too complex products. In perfect world, we as a customer we would say, okay, never invest in something that you don't understand. Okay, that makes sense. And we understand that it's our responsibility to find out what these products really are about. But many customers are financially unsophisticated. So elderly, kind of poor, and as simple as that, many people are not interested in these kind of products. So that is the challenge for the whole functioning system, that people are not interested enough to find out how banks are doing, how solid they are, what the products are about, and that's why we need customer protection. That is actually something that we already discussed. Financial products and services are quite complex, and most consumers don't have a professional finance training, which is kind of totally makes sense. So that has led to ever and ever more kind of regulation in the markets. First in Europe, say Minister of Finance in Finland is responsible for banking regulation, and this is the same for any European country. Minister of Finance is responsible for that in Finland. Minister of Finance of Germany is responsible for banking regulation in Germany, but banking regulation is probably harmonized within the European single market. So the rules are pretty much the same. They're just nationally kind of applied. The regulation is applied by the national Minister of Finance, according to the European Union directives. That is the idea, that we decide something on the European level as directives, and then we apply those into national legislation in each European Union country. There are some other national institutions, international institutions, G20, Basel, we were already discussing about financial stability, what we will discuss shortly. So there are some supranational institutions which have launched different regulation, which may or may not kind of applied in national regulatory decision making. Banking sector regulators, we have discussed about the ECB taking the responsibility of supervising the biggest European banks. The European Banking Authority kind of covers the regulation of all European banking. In the US, there's Federal Reserve Board and Senate Banking Committee. Something that we have been discussing kind of indirectly already is the deposit insurance institutions. These are institutions which guarantee the bank deposits. In Europe, it's 100 euros per depositor per bank since 2009. There's a Finnish institution which kind of is in charge, is Financial Stability Authority. We have the same authorities on each European Union country. In the US, FDIC covers $250,000 US per depositor per bank. So that is a national kind of level, federal level institution. We'll have also European Securities Markets Authority, Securities and Exchange Commission in the US. We have many different institutions who have their own responsibility areas. So many national and international kind of regulators. What do they regulate in banking? First, structural activities, bank liquidity, transparency, and capital adequacy. Capital adequacy we have already discussing about. Structural activities. This is something that we might recall from the Inside Job movie. Inside Job movie referred to this Glass-Steagall Act, which was adopted in the US in 1933 after the Wall Street crash, 1929, Great Recession, when banks kind of collapsed and people lost their bank deposits. But just kind of for the sake of kind of clarity, why do we need these deposit insurance institutions and deposits to be covered up to say 100,000 in Europe or 250,000 in dollars in the US, is that customers, not being financial experts, not being interested in financial statement analysis, not being kind of a any interest in comparing different financial institutions, are still willing to park their money as in bank deposits. So without any risk to lose these savings. So that's why, because that is considered on a economy-wide level, as that is something that we already were discussing. So everybody benefits. This is one of these externalities, that as we are willing to park our money at a very marginal, if not even zero, as it is current environment, a return interest on money in the bank. So that money is then, banks can use those deposits to make loans. The payment system works. These externalities is something that everybody enjoy. So that is something that is considered to be good, necessary. The question is that why do we need a certain maximum? Why don't we just say that, okay, everything is kind of covered? There's a cost, and this is the cost, something that we will discuss. That would lead to banks taking excessive risks. We could say, somebody could deposit 100 million, and if there was no risk, so the bank could utilize this and make kind of massive loans and take massive risks, and in a way utilize, say, would it be a government, would it be whatever is this institution? Government is not kind of covering these. It's the Financial Stability Authority, and these there's a the idea is that banks need to finance. They need to pay this, so that the government would not take, because obviously this is a like a insurance, and government should not provide, and government is not providing this for free, this insurance. The idea is that for the banking sector, banks would be, as they are utilizing this benefit, they are utilizing the benefit that customers are willing to park their money at a zero interest rate on the bank accounts. This is something that banks utilize. So for this benefit, banks should pay something, and they do need to pay something. They need to finance. They need to park money. There's a fund that is being collected per bank. And now this is kind of the key question: is that should we make this European-wide, or can we leave it as a national level as it is currently? This is about, as we'll have later on, this is the third pillar in this European banking kind of system that is still missing. Okay, that is about the bank deposits. Okay, then what was in the US, what happened was that the common takeaway, you would say probably wrongly, but anyway, that was the lesson from this crisis, was that Wall Street banks were very active in speculating in the markets, and once they lost as a result of kind of risks realizing, so also bank depositors lost. So the idea was that commercial banks should separate. Commercial banks should not be allowed to participate in underwriting securities, brokerage, insurance, real estate activities, but the commercial banks should be focusing on commercial banking only. Investment banks are different, and investment banks were not let to take in deposits. So that was a big regulatory change since this great recession in the US. Then tens of years kind of passed by. In Europe in 1988, there was something called Second Banking Directive. So that allowed banks to offer full rates of financial services, securities operations, insurance, pensions, leasing, something, if you visit Nordea, if you visit Aktia, from Aktia you can deposit money, you can borrow money, you can buy savings products, you can buy life insurance, you can buy other insurance, you can buy whatever, you can make pension savings, leasing products, most probably kind of Aktia offers for its clients. So this is a European style that was allowed already in 1988, something called universal banking. So banks can undertake investment banking activities. You can open a securities account at Nordea. Nordea is able to. They also operate as an IPO, initial public offering kind of. They have an investment banking section which can give kind of underwriting services for companies. Do in an IPO, they can do whatever operations. So that was considered to be good for the market in Europe. Something that American banks were complaining. They were complaining in public. They were saying that they are losing their competitive edge is weakening as European banks can run this universal banking model, while American banks need to focus on investment banking or commercial banking only. And it took until 1999, and remember this Citicorp Travelers merger, which was mentioned in Inside Job movie, took place a bit earlier than this Gramm-Leach-Bliley Act, something called Financial Modernization Act, was adopted. So that opened the door for these financial conglomerates also in the US. So that was a big step in, you could say, in deregulation. While this was regulation, this was deregulation on the path, kind of continuation of the trend that started in early 1980s. One step was this Gramm-Leach-Bliley Act, which kind of replaced the Glass-Steagall Act. You remember this picture from the Inside Job movie, this oil tanker. So 2010, then President Obama signed something called the Dodd-Frank Act. And there was this is a bit kind of a specific, but it's good to know this because these terms are every now and then referred to. So Financial Times every now and then kind of refers to the Dodd-Frank Act or Volcker Rule. This Dodd-Frank Act, which was a massive 848 pages long kind of text of regulation, the Volcker Rule of many kind of stuff, many issues. The Volcker Rule was one section of this. The idea was to reduce banks' ability to take excessive risks by restricting proprietary trading and investments in hedge funds and private equity companies. So what this proprietary trading is that bank take risks with its own balance sheet. So this was deregulation 1999 after the global financial crisis. Another kind of turn was to start regulating kind of the market. And this Volcker Rule the flavor was like from Glass-Steagall Act, that the commercial banks should not be allowed to be active in speculative businesses, such as hedge fund, private equity, or prop trading. So discourage banks from taking too much risks. That was the idea. Then again, President Donald Trump, when being the candidate for the president of the US, he told that he promised to give a haircut he said that we are going to do a very major haircut on Dodd-Frank. So this was in 2017. And he did a change, and that was in 2018, especially for smaller banks. So smaller banks were kind of freed from some of these restrictions. So it's important to know that Dodd-Frank is an American regulation that has to do with the financial sector, and especially the structures and activities. And Volcker rule is a section of this which had to do with the risk-taking activities of American banks. So that is what happened. What really changed was that, especially for big banks, not too much change. So big banks still are, they need to follow this Dodd-Frank Act. Meanwhile, in Europe, already 2014, something called Liikanen report was published, and Erkki Liikanen was the former chairman of Bank of Finland. So there's a Finnish link here also. The idea was that it aimed to stop biggest banks from engaging in risky activities of proprietary trading. So again, proprietary trading is was something that big banks were kind of, the idea was that we limit their ability to do prop trading, which is when a bank or brokerage company trades on its own account rather than on behalf of customers. So they use their own capital and balance sheet to, which they speculate, take view in the markets. So that is proprietary trading. What happened then was that this was a proposal 2014, already 2017. It was European Commission withdrew it. So they said, okay, we scrap it. Yeah, there was not kind of enough political will or willingness to adopt it. So in Europe, we did not adopt this kind of a new law, and that's where we are currently. There's a question in chat. Do you think ESMA and SEC have the resources in the buildings? This is a, you remember from this Inside Job movie, as there was a representative of a SEC, what was kind of the division that he was responsible for? As the question was that how many people are controlling as they have been cut, that was before the great financial crisis. So they have been cut resources, and there was just one person, and the question, okay, when this one person goes home, so it just closes closes the door, and there is nobody. And this is a constant kind of challenge that obviously question is that in society, in economy, how much resources should we allocate to the financial supervision and the regulator? The regulator, I guess, always says that we have limited resources, too little resources. What could be that banks themselves say, okay, the resources are not that small. They complain that the regulation is kind of regulation per se is too much, and regulators are too tough. Obviously, as you explained, as you mentioned, in the US, Madoff's kind of a massive fraud, 50 billion plus minus. How can that be that kind of investors lose 50 billion in a say 100% fraud? Theranos, the more recent kind of case, fraudulent more or less, hedge fund market manipulations. To be honest, if you ask my opinion, I can't say. And the reason why I said that I can't say is that definitely, as we have seen these cases, so something has gone wrong. Then the question is that, is it about the amount of resources? This is a bit beyond the topic of this course, but the Madoff's case, which is there's so much you can learn from this. Madoff's, he operated on Manhattan in this lipstick building. You could say very close to the SEC. SEC made some efforts to find out how is Madoff. Is there something kind of fraudulent, something suspectable happening kind of in Madoff's fund? They visited them, said they investigated and found out that everything is good. There was a whistleblower who contacted SEC and said that this can't be right, the performance is too good, and it's simply impossible that this fund is kind of operating as they claim. SEC visited kind of Madoff's offices, investigated the reports, and find out that everything is good. And it turned out to be 100% fraud. So it's not about the amount of resources. I guess it's about the quality of resources. And how can you make sure that this will never happen? I don't know if anybody can say. Kind of what is the sky is the limit. We can use double the amount of resources for SEC, and still this would happen. So there is I guess the biggest lesson from all this is that remember this, and that is, let me see how we are. It's not black and white. This is what makes this intriguing, so fascinating of a field, is that the starting point should be that caveat emptor. The buyer has the obligation to find out if the Madoff is offering him a fund to invest. Is the customer's duty, obligation to check that, okay, what is this fund really about? And if it turns out that it's a fraud, its customer can only blame himself or herself. So that is when we talk about, say, investment products. But why don't we base everything on this? So that would mean minimalistic regulation, minimalistic supervisory activities. Because of these externalities, the common understanding is that everybody in society benefits on even the people who are not willing to make financial statement analysis or whatever analysis about different financial products. They are also willing to put their deposits into the system so that banks can make loans for the society, keep the payment system operating. So that is the common understanding. So for that reason, say the society or different actors, different institutions within the society, we have built these different institutions, such as these depository institutions, financial stability, the fund. We have collected the money and say to make customers trust the system. So you can trust in the system, your deposits are safe, you don't need to worry. That has led to many customers consider that the banking system is sound. This is kind of the prerequisite for the system to function. But sometimes customers also, the investors, trust the system too much. And one could say that, to answer your question kind of in short, I guess the current system where we do learn from Madoff's kind of cases and from Theranos kind of cases and from different frauds here and there, each of them is kind of too many. But the more we report about those, and everybody reads about those and reads and sees kind of there's a great book written about Theranos. It's a documentary on Netflix. Great kind of encourage everybody to take a look at. And Madoff there's been movies on Madoff's case. The more people read about these cases, people become more aware of different risks that there are. It's not the regulator's task to avoid risk taking. Also, that is one dimension. So if somebody wants to speculate kind of 100% and is willingness to take the risk, so that should be let to happen. If it turns out to be fraud, okay, the customer is to blame. So it is it's fascinating question how much we should. I guess at the end of the day, the best solution for this is that the more financial education, the more people get kind of to understand how the financial system, the less market, the smaller is the market for different new fraudulent kind of cases. I guess that is the best one can conclude. Or is there something that kind of I can't. Hedge funds we'll talk about kind of on Thursday as well. So hedge funds, if something, so that is caveat emptor. So as one example, hedge funds, as you mentioned that, there's a regulation that hedge funds cannot be targeted to retail clients. So retail clients are kind of like these everyday or average Joes, or everybody. So they can be only promoted, and they can not be advertised. They can not be kind of sold to retail clients. They can be only targeted to professional investors. And to qualify as a professional investor, there are certain requirements, different in the US, different in Europe. To qualify as a professional investor, as you qualify as a professional investor, your customer protection is less. So you have less customer protection as you have qualified and said, okay, I understand and acknowledge that I understand the risks that I'm taking, and I want to speculate, I want to make my trades, but if something goes wrong, I'm not for the government kind of to ask to help me out of that. So I carry the risks. So that is two different segments of clients, as you refer to hedge fund market as an example. So hedge funds are not for everybody, only for the dedicated professional investors. But still, while saying that, don't take me wrong, any wrongdoing, any fraud is too much. So we shouldn't have them. And the more we learn about them, the less there is room for new ones. Any other questions concerning this? Everything good? Shall we move to liquidity? So as this was about structure and activities of banks which are regulated, and there has been major change, deregulation, re-regulation, deregulation, and so on, over the past only 15 years or 14 years. That's structure. the next one is liquidity, which is obviously in the core of bank run as a risk. Okay, now it's 15 past 2. Now, how about not having a break today? Let's just continue to the bitter end. So European banks, this is on an aggregate level, as we'll see, that income sources, and this is where European banking sector has been a bit weak, as so big proportion of the income comes from the net interest income, so the difference between borrowings and lending rates. So that is now as interest rates have gone down to zero, deposit rates even negative. So there has been a major profitability burden or push for lower net interest income for the banking sector. So that is a challenge. So net fee and commission income still only this is the latest figure I found from a source. So something like 30% comes from net fee and commission income. This is all the banks in Europe overall. So banks do finance their operations very much on bank deposits. And as there is this, banks, the risk, the feature that banks need to meet this foreseeable demand for withdrawals. So to protect banks, we need government safety nets. The lender of last resort is one. The facility that banks, they know that every day if we don't have the money, we can borrow that from central bank, plus the deposit insurance scheme, which is something that we were discussing on the third lecture, slide set number 4. In return for these, to provide these the facilities, the central bank agreeing to act as a lender of last resort, that we have this deposit insurance scheme somehow, currently national. There has been a proposal to make that European-wide. So in return for these facilities, regulators monitor the liquidity of the system, and banks are required to make frequent statistical filings so that the regulator can see how much liquidity the bank has. And now there has been new limits being adopted in Europe, also adopted according to Basel III, liquidity coverage ratio, which is a quantity of high quality liquid assets that the bank must have relative to the total net cash flow over the next 30 calendar days, something that the bank expects that it might need to pay out. So cash outflow within the next 30 days, bank needs to have more than this of a high quality liquid assets, so that it prevents bank making only illiquid loans, which would risk or which would increase the risk of a bank run. So this is the liquidity coverage ratio. New requirement, just took from Nordea's annual report 2018, annual report saying that the liquidity coverage ratio for Nordea Group was 185%. Actia's the same year, it was 134%, while the minimum was 100. So they seem to satisfy these. The key here is that they have liquid assets, enough liquid assets to meet these probable outflows within the next half a year. 1 month, 30 days, sorry. So that is liquidity coverage. So another new minimum that was launched starting from 2018, as I suggested, this Basel regulation is adopted on a national level on various stages. So it started, as far as I remember, this was required in Finland in 2018. So very recent anyway. So net stable funding ratio, available amount of stable funding divided by required amount of stable funding. So this would be more than 100%. So let's not go into details of how these stable funding kind of what make those. So they're a bit tricky, but anyway, what is enough for us is to know that new minimum was set, that available of amount of stable funding should exceed the required amount of stable funding. Transparency. So this is the liquidity. Transparency is one thing which is pretty. It's so obvious that sometimes one forgets that this is pretty relevant as well. Banks or financial services providers kind of need to be transparent about not only their own financial health, liquidity, leverage, and so on, but also they should be transparent of the products that they offer for clients. So there's transparency in many different forms. One issue here, and this is the same, this just happens to be Finnish, but the same is in each European Union country. The supervisory authority ensure the supervised entities' procedures are appropriate, that the information given to customers is good quality. So they supervise the players. And for example, once a company plans an IPO, the prospectus need to be accepted by the financial supervision. Just one kind of like a case. On mutual fund, the mutual fund prospectus, the rules, they need to be taken to the financial supervision, and financial supervision accepts those. So they supervise, and this is a big thing, kind of that financial supervision supervises many players in the financial markets, but not all. So there are certain segments, such as, say, crypto market, which is something that Eugen will discuss next week, Thursday. So, or currency trading. So financial supervisory authority is not supervising crypto players and many other players as such, which is something that customers do not understand. So for you, when you consider any investment in anything other than in a major bank or say respected kind of a financial institution which is well known, so any more exotic, any kind of a smaller player, find out whether that institution is supervised financial institution or not, financial supervisory authority or not. But as they say explicitly here, financial supervision supervisory authority is not vested with the power to resolve any juridical disputes between customers and service providers. When something then, the customer feels, okay, I invested in mutual fund and something went wrong, or whatever, could be more exotic products which there are, so that the customer should not go to financial supervisory authority, but they should go to financial ombudsman bureau. So that is where, which provides financial advisory services, investigates disputes with the service provider and on your behalf if necessary. So there's a separate institution. This is the same in each European country. So there is a separate institution for, like FINE, the Finnish Financial Ombudsman Bureau. FINE provides customer advice to customers and issues recommendations for the resolution of disputes. So this is where these, if something goes wrong, this is where these are solved. There are certain recommendations, and you can contact them. So this is, the idea is that to help customers to avoid making kind of decisions that are not appropriate for the customer, kind of for especially for the ones that are not financially kind of knowledgeable and not interested in this product. Then what is also regulated, which is you already know, is the capital adequacy. The Basel Committee makes these recommendations, which is then adopted on the local side. This is something that we discussed: Basel 1, Basel 2, Basel 2.5. There was Basel 4, Basel 4. Just one example of a new floor, which was mentioned in Aktia's case, but it was rushed a bit quickly. So there is a new set of minimum weights set by the Financial Supervisory Authority in Finland, a minimum risk weight of 15% for residential mortgage loan. This is something that I suggested, that when banks were allowed to adopt their own IRBA models, so especially Nordic banks kind of ended up with very, very low risky mortgage loan portfolios, which essentially they are more or less kind of risk-free from banks' point of view. So the lower the risk weight, the less equity capital is needed. That is kind of the whole how this goes. But the regulator recognized that now we have gone too far, so they put a 15% minimum risk weight. So that was like a floor. While Aktias, when applying their own internal risk-based methodology, they had kind of ended up to 13%. So this means that the new effect, the effect of this new rule will be not significant. So that it was Aktia's kind of takeaway from this. So already then, now this Basel IV has other implications, as there are ideas that banks would no longer be let to use their IRBA models, maybe at all. But this was already a couple of years ago. There was a recognition that banks do face their risks on so small that it was maybe too much, maybe too much kind of the new force were set. The last thing, something that we have mentioned a few times here and there, the systemic risk, which was a new thing that that was underestimated, that was recognized, that was unthinkable. But this global financial risk and global financial crisis revealed that there is something that has been building over the years that we should be more aware of, and that is called systemic risk. 2021, so this has been kind of going for years annually. The Financial Stability Board, they do publish the third kind of the banks, which according to their analysis are something called global systemically important banks, ESIBs. And they will be subject to additional capital requirements. So in 2021, the latest ranking, there were 30 of those institutions. Globally systemically important banks are defined as institutions whose distress or disorderly failure because of size, complexity, and systemic interconnectedness would cause a significant disruption to the wider financial system. So this is something that a few years ago Deutsche Bank was clearly number one. No longer the latest ranking. There were JP Morgan Chase, BNP Paribas, and Goldman Sachs. These were pretty much on the top. So the Financial Stability Board announced that these institutions need to hold additional capital buffer. So they have the right to say do this. This is public information, which these banks are. Why this is important is that have a higher capital buffer required, and many other kind of dimensions, which in summary, those ones which are systemically important, they need to have more capital than other banks because they are considered to be systemically important. Nordea, which used to be one of these, no longer is. Just as an example that it becomes pretty complex, Nordea's capital and risk management report from 2020 was 199 pages. A few years or 5 years ago, it was only 98 pages. So this is becoming more and more a kind of complex. Plus, there's something called countercyclical capital buffer and other requirements. Just as an example from Deutsche Bank, when it was at its its peak in terms of being globally the #1 systemically critical bank. Overview of total capital requirements and capital buffers. So 2013, 8% was enough, but now it was close to kind of 20%. So there's something called systemic risk buffer, institution-specific capital conservation buffer, GSII kind of a buffer. So the lesson from here is that the bigger the bank, and especially the more complex the bank, the more different layers of capital is being required. So the more simple the bank, the smaller the bank, the less capital is required. So this is obviously totally different world than any non-financial institution. So think of industrial companies. Why would the regulatory kind of or equity capital being required by the regulator be different for, say, forest company or the metal company? No way. But in banks, there are pretty massive differences in terms of requirements for different institutions. Then the question is that what are the costs? And that is a tough one. There are 4 issues to consider: moral hazard, agency capture, compliance costs, and barriers to entry. Moral hazard, as the regulator, I once suggested that banking world says, okay, there's a regulatory tsunami, and this is something that banks have been complaining. And this is just one example of Nordea's then chief in Financial Times saying that the regulation goes too far and we need to stop it. As he starts, it can't be so that the only purpose of banking is to stop banks going to bankrupt. And anyway, this is different issue, but it's kind of for the question that how much should the SEC have resources to prevent something like Madoff or Theranos happening. I don't know. You can always think of more, but you can't have. There's a balance. There's an optimum is somewhere between maximum and minimum. And what banks have been complaining ever since global financial crisis, that the regulation has become too tough. He suggests that there is a much cheaper way of avoiding a financial crisis, and that is the politicians take responsibility to avoid asset bubbles, because they are in reality creating a pretty critical statement. What is, I just took it as an example that bank shareholders and bank managers have been complaining about this new regulation. What are the costs? Obviously, there's always a fundamental conflict between what is good for bankers and what is good for the broader economy. Banks shareholders would like to tie as little capital in the business as they could, and they would like to have as little kind of as light capital requirements as possible, as it was the case in 2007-8. But the idea is that the taxpayer says that we don't accept that, because this heads I win, tails you lose. The rules must be fair, instead of kind of you taking the upside and we paying the bill if something goes wrong. Moral hazard. there are two concepts that may lead to moral hazard, and the government safety nets and something called forbearance. And this is something that actually we have been discussing. With deposit insurance, depositors have no incentive whatsoever to monitor the bank anymore. So if you know that, so if the government says that these are, or the regulator says that these are, the deposits are guaranteed. So why should I use my time and energy span kind of to find out how good of financial health this bank is? Bank directors know that this is a lender of last resort anyway, so we can take more risk. And so this is a moral hazard issue. So we should not have maximum deposit insurance, and there must be some cost in banks' ability to borrow from a central bank. So that is there's a balance somewhere there. The system needs people trusting the system, but not trusting too much, or at least the banks. There should be a cost as they have this ability to rely on the deposit system, deposit insurance system, or depend on the ability to borrow from the central bank. Forbearance, this is a tricky one, but very interesting, is that obviously the financial supervisory authority, they supervise the banks, they follow how they're doing, but if they find out that at some point that the institution is taking too much risks, or facing some problems. So by announcing that, as one of the examples of this Northern Rock was that it became public that they had borrowed money from the central bank. So that piece of information was fatal for the bank's operations, because as it became public, everybody recognized that the bank is in deep problems. So regulator needs to be very careful in making some observations public, some observations that they recognize that the bank there are some challenges, some problems within the bank. They can't publicize this because just one news article might collapse the whole bank. And this forbearance means that bank knows this. Bank knows that the regulator, there's a pretty high bar for the regulator to publish some observation that something is not, things are not running smoothly. There are some risks that are going to be recognized. So they have recognized certain risks which are going to realize. And this is something that the regulator aims that the bank is given time to solve with its own operations, not making them public. And with this public announcement, the whole bank's operations would be risked. And as the bank knows this, they bet on this. So they can play on the regulator's tough position between the public and the bank. Compliance costs. So a lot of compliance costs, data privacy, anti-money laundering compliance, more and more that bank employees need to report, keep records of all the new regulation, and this has resulted in massive higher costs which obviously needs to be then paid at the end of the day by the customer. So there are a lot of new costs for the whole financial system. And then the last one, barriers to entry. The more we set liquidity requirements, capital requirements tougher and tougher, so the more difficult it becomes for a new entrant to come to the market. So, and this reduces the competition for banks. So thinking of nowadays kind of to start a new bank, I could even think of that kind of a, at least with the same terms as the current banks that we are seeing. Just as an example that we are concerned, America, the big concern as the Inside Job movie kind of highlighted was that it was like the big banks, there were too few big banks before the global financial crisis. After the global financial crisis, they have less, the number of even smaller than it was beforehand. So there's a, as Mikko Auk was referring that in what was that, OP and Nordea in Finnish market, the market is 70%. So pretty oligopolistic system, which may lead to inefficiencies. I'm not saying that the Finnish banking system is not efficient, but there's a potential that the less players we have, you might expect that, okay, the less efficient the system is. So these are the different costs. If we go back to the questions, why do we need regulation? Oh, for various reasons. Without regulation, investors were not protected. Depositors were not willing to put their money in a bank account. We would not trust the system. We need a system that we need to regulate the capital adequacy, liquidity. We need to have a deposit guarantee system so that we get the deposit and customers, even the ones who have no financial education and knowledge and interest in this market, are willing to bring their money, to borrow money, make savings, kind of long-term savings products, invest in savings products, pension investments, and so forth, and so on. Who regulates? It's different institutions in different countries. In Europe, it's kind of a European regulatory kind of environment, which is adopted on the local level, on the national level. What do they regulate? They regulate different kind of stuff. Activity structure, transparency, liquidity, and capital adequacy in the banking world. And all they are all important. And what are costs? The costs of multiple different sources of costs. And then it's not black and white. It's kind of it's not easily measurable, but it's not cost-free. And that's why, as you could say that you can take it as given. There's no question that, of course, we need to regulate banks more to avoid something that happened in 2007-8. Okay, the more we have made the life of banks more, say, demanding, more challenging, the higher is the barrier for new banks, and the more there is room for companies providing similar type of services without the regulation for banks, which is called shadow banks. So, which look like a bank, they operate, they compete against banks, but they could be, the business can be run as much less regulated environment, and that's why there's a fine balance when you could easily say that now we are regulating, the bar is too high for banks, as the shadow banks are led to run their business with much less capital, less reporting, less liquidity requirements, everything kind of, that's why we are talking next on Thursday. We'll talk about the shadow banks, which makes, say, roughly the other half of the financial services market. Banks make 50% and shadow banks make the remaining 50%. That is the topic for Thursday. Any questions, comments on financial regulation? On Thursday, we'll talk about the mutual funds, hedge funds, ETFs, private equity funds, investment banks. Any questions, comments? Everything good? Okay. See you on Thursday then. Cheers.